Hey there, and welcome back to Red Sparks Crypto Blog for your crypto and Cardano news. Firstly, just to acknowledge I have a new mic, as hopefully you've noticed. Thank you for those who helped me test it out, and in particular the person that pointed out to me that I was recording in left channel only. Amazingly, it's something I hadn't picked up on before. I guess I'm just too used to hearing my own voice, but it's made a tremendous difference, as I'm sure you'll appreciate. So thank you very much for that. Okay, we're going to start by looking at the charts. Now, I haven't done one of these in a while in my video because I don't really have that much to add. I'm sure you're all aware of prices, and prices are unpredictable and nobody knows what it's going to do. But essentially, it's been a story of what Bitcoin giveth, Bitcoin taketh away. So earlier in the week, well, I guess just before the Bitcoin Miami conference began, it had pumped and then it had dumped, and then it looked like it was recovering and it's dumped some more. So it's not looking great from that point of view. But that being said, if I had a longer chart, maybe if I click on here, we'll see that over the course of the last, let's go for the last 3 months. Generally, it's been on an upward trend. In fact, let's go a bit further out than that. Let's go for a whole year. So we know this was a great sort of depression that happened down here, and it then sort of stabilized a bit, and it appeared to be going up. And so this dip, in the grand scheme of things, isn't too bad, but it's still obviously uncertainty. But I'm, again, not financial advice, but I'm hoping it will bounce around and go back up eventually, and hopefully we'll see this sort of peak realized in the next couple of months, so that I can buy a place to live. That would be rather nice. Okay, that's Bitcoin. Let's click on our favorite Cardano. Yeah, well, let's see. Let's do the same thing. Let's do a year. So up and then down. A long way to go for the recovery. And then in the last 30 days, things were looking up. We hit our beloved $1.20, our safe zone. I thought we'd hang out there for a bit longer, and it's gone back down again to close to $1. So that's not good. But I don't know, there's so many bullish things happening for Cardano. I know we're all waiting for June. So certainly the build up to June, I expect Cardano to go up. But really what I think is going to happen is this whole buy the news, sell, which way around it, sell the rumor, buy the news. No, buy the rumor, sell the news. So I'm sure come June we'll see another dip immediately after. But it's more of a long-term play. We've got loads of dApps that will be launching post-June that I just can't see it staying down for long. So I reckon, again, I have no idea what's really going to happen, but I reckon it'll continue to sort of work its way up, subject to what Bitcoin does, of course, over the next couple of months until June. Then there'll be a dip, and that'll be a great buying opportunity, and then it should shoot off. So we shall see. The other coin I've now started tracking, as I now have a bigger investment in this, is good old Coty. Let's go over to Coty. So Coty had been pumping for the last 14 days, and I believe that's because of the availability on Binance US, which occurred around this peak over here. And me being me, with my terrible timing, I decided to buy into that peak. In fact, I bought into that peak just after that little first dip that you see there, thinking that was a good opportunity. But I never learned my lesson. I should really just wait. Anytime I want to buy something, I should just force myself to wait 6 hours, because 6 hours later it was down here. But nevertheless, it had rebounded quite nicely today. So that was quite good to see, although it's gone back down again because of Bitcoin. So quite volatile trading there for Coty. But the reason why I decided to invest in it, and let's just zoom out a little bit more onto the macro picture, is that I see Coty as a hedge against regulation. There's going to be a lot of regulation this year, and Coty is one of the few coins that has always tried very hard to toe the line and do things by the book. So I know Coty's got its criticisms about being, centralized, in that I don't think it's got that many nodes. Although I've heard conflicting things about it. And there's this thing called a proof of trust. So you have a trust score. So there's a few things that raise a few eyebrows for people. Personally, I actually kind of like their DAG method and the proof of trust idea. To me, actually made a lot of sense. But yeah, so I thought that COTI generally is a very good hedge against regulation. And there's a lot of positive news around COTI, and I like to see these sort of frequent updates. So COTI has joined the Cardano DeFi Alliance. That's pretty good. COTI and MinSwap have got a partnership to explore the integration of the JED stablecoin. They're listed on Binance US, as I previously mentioned, and so on. So you can see there's a whole bunch of news churning out of COTI on a regular basis. And somewhere down here, they also have their roadmap. Let me see if I can find that. So this is their roadmap. The treasury, which was launched recently, is actually quite nice to use. If you haven't used it, you basically can put your money into the treasury, and they have this little user interface that lets you decide how much risk you want to take on, what the return on that risk will be, and how far the price will have to drop in order for you to then get liquidated. So I chose 2x. It goes up to 4x. 4x is the riskiest. 1x means there's no chance of liquidation. And I've locked it up for 30 days. You can do 30 days. You can also do no lockup, 30 days, 6 days, and 90 days. So I've gone for the lower end of the risk curve, I suppose, but there's still a bit of risk there. So a little bit of nervousness for the next 30 days. And the lowest return you can get, which is risk-free, is around 6% or thereabouts, which is marginally better than what you get from staking ADA. Though, of course, COTI has more risk attached to it in general. And the higher end of the return, I believe, is 45%, but I think you'd have to be a DeFi degen to go up that high. But you see, they got a nice little roadmap here, various different things coming out. I'm going to have to research the multi-DAG Foxnet. I don't know what it is, but it sounds pretty cool. DAGs, if you don't know, are direct acrylic graphs. It's just the idea of a network, kind of this little picture here. And they generally allow you to do certain types of computation much quicker. And they kind of make sense for blockchains, I would argue. So anyway, they've got a good roadmap. They're hitting a lot of their targets. The JED testnet is out. I know there's a lot of question around when's JED going to come out, but we'll see. We'll see. I'm not putting all my eggs on the JED basket, as other people seem to be. It'd be great, obviously, when that comes out, but I've been learning a lot about stablecoins and algorithmic stablecoins in the last few days and last few weeks. I'll do a separate video on that, but my enthusiasm for JED has tempered a little bit. But even without that, I feel there's a solid roadmap here, and the focus on enterprise tokens. I think that's going to be very interesting. Anyway, that's just my reasons for investing in JED. I'm definitely not trying to shill it. I'm not trying to pump the coin. I'm not trying to get you to buy it. In fact, probably do the opposite of anything that I say is my advice. A censorship-resistant inflation index is being built on Chainlink. Trueflation currently measures a 13.3% inflation rate, as opposed to the 7.9% measured by the Consumer Price Index in March. So this was a great story, I thought. Very good use of blockchain. The CPI, if you're familiar with it, or if you're not familiar with it, is a kind of a government-issued tracking of inflation, and it's built on some sort of obtuse methodology, as it says here. It's a black box. We don't know how they made the survey, how they executed it, and so on. And the surveys are quite dubious. Essentially, they do a survey that collects about 94,000 prices per month. They try and determine inflation based on that, but you never quite know what they're doing to that data. So which is the point of this sentence. So Trueflation has created their own index, and it's open, it's transparent. You can see how it's being calculated. You can see what data points it's using. And it's modeled in a similar way to the CPI, but it's different because it measures and reports inflation changes daily by using current real market price data from sources like Zillow, Penn State, and Nielsen, amongst others. So in my opinion, it's going to probably be a better measure of inflation than the so-called official measure. It runs on Chainlink and is therefore accessible and visible to everybody. And as the title said, it's measuring inflation at a much higher rate than what the CPI is claiming. And given that the CPI has been rather late to the game and tried to play down inflation for the last 6 to 12 months, I'm pretty sure the real inflation rate is much closer to 13.2%. But anyway, I thought that was a great article, great use case for blockchain there. Top US bank watchdog warns of stablecoins' lack of interoperability. The OCC's acting chief argues a variation across tokens could create walled gardens. So I picked this article because it brought up a very good point that I hadn't thought about before, and that is that stablecoins, as we have right now, aren't interoperable with one another. So they're all pegged to the US dollar essentially. So in theory, they're all worth a US dollar, and they should be quite fungible with one another. But their actual protocols are, as the regulator here was saying, walled gardens. So Sue, who is among several US regulators working on guardrails for how stablecoins should be overseen, noted that a single type of token, such as Tether, isn't the same across different blockchains, nor is it directly exchangeable with other dollar-based tokens. If private stablecoins ever become a common means of buying and selling things, they can't be freely swapped with each other, in contrast to a dollar deposited at an institution. Without interoperability amongst US dollar-based stablecoins, the risk of digital ecosystems being fragmented and exclusive with walled gardens is heightened. If or when stablecoins expand from trading to payments, this lack of interoperability will become more apparent. So you could argue that stablecoins are interoperable with one another. For example, two different stablecoins built on the ERC20 network would probably be easy to swap for one or the other on whatever platform you were using, and there's no reason why you shouldn't be able to do that. I guess problems occur when you're moving out of the ERC20 standard to other standards. That's when it's much harder to convert one to the other, as we know from how long it took to build the ERC20 converter. So I thought that was a good point, that we should really make sure stablecoins are very fungible with one another, just like $1 is $1 is $1. No matter whose pocket it's in, you can swap one out for the other. It's exactly the same. Can we say the same about USDT and USDC and all the other ones? Is one of those exactly the same as one of the other, and we'd be happy to have either one? Or would we say, actually, even though they're all equal, some are more equal than others because we trust them more, for example, like USDC over USDT. So I thought that was a good point. I haven't fully thought through my thoughts on the matter and what the solution is, but I did think it was a good point. The other part of this article I found interesting, though Sue has been an outspoken critic in the past of crypto's potential hazards, blah, 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 his latest remarks revealed he's not entirely dismissing the industry. How very interesting. As Treasury Secretary Janet Yellen did in her first speech on digital assets on Thursday, Sue granted that digital asset innovations may dramatically revolutionize the system. Today, cryptocurrencies are used primarily for trading on exchanges. Tomorrow they may collapse and exist only in the shadow peripheries of the financial system, or they may grow and power the next evolution of our digital lives and the digital economy. So clearly, both with Janet Yellen and this person, there must be some memo that's been going around government circles saying, hey guys, we actually see crypto as being an opportunity, not just a risk. So let's try and rethink things and be a little bit more open-minded, shall we? Shopify Bitcoin payments integration triggers legal questions from the community. Attorney Kevin Thompson thinks that the event will make regulators frustrated, leading to the creation of reporting requirements for Shopify. So if you haven't been following the news, then you may not have heard that Jack Mallers announced. Jack Mallers owns Strike, which is a Bitcoin payment company. And he announced that they've now got Shopify to accept Bitcoin payments, which is a major e-commerce platform. as well as another point of sale platform which isn't mentioned in this article. But they were both positive news for Bitcoin, and he even demonstrated going into a grocery store and paying for your groceries using Bitcoin in a variety of ways. Now, the first thought that came into my mind when I watched that was, what about taxes? And it didn't take long for others to point that out as well. So Matt Alberg here says, what Jack Mallers is really saying is that you will soon be able to offload your Bitcoins in the real world without KYCing through an exchange first. If this is true, it is actually an extremely substantive and important development for Bitcoin. He seems a lot more positive on it than I would have been. And in fact, the lawyer, Kevin Thompson, came to rain on his parade in a reply that the event is likely to make regulators frustrated. Being able to spend BTC without going through KYC enables users to dump BTC and avoid taxes. He predicts that regulators may respond to the event by creating reporting requirements for Shopify. Not to shit on the parade, but I'd be absolutely stunned if the US government just accepts you walking into any major store and spending Bitcoin KYC free. Ultimately, they can't stop it, but I'm pretty sure that they're going to fight it. So yeah, it should be interesting to see how that plays out. But I think it's a great development that you can buy groceries with Bitcoin. Regulators are just going to have to catch up and figure out what that means from a reporting point of view. Personally, I would love to be able to spend my crypto using a debit card and then have the debit card app tell me how much I've spent and therefore how much I need to sort of report for tax purposes. But I'm sure these things will evolve. We can't all just be stuck in the past using old methods of payment. So there's the annual Bitcoin conference going on in Miami right now. And I've got to say it's a significant improvement from the one last year, which was a complete and utter cringe fest with a whole bunch of Bitcoin maxis being on stage, insulting other coins, and just feeding hopium to the crowd. There wasn't much actual substantial discussion. And then you had Bukele come in and just announce that El Salvador was going to make Bitcoin a currency, and that's what everybody sort of talked about. I think they've learned their lesson. This year, from what I've seen, it's been a lot more subdued, a lot calmer, and the conversation has been much more around actual adoption of Bitcoin and how to enable that. And one of the things I've been quite impressed with has been the discussion around Bitcoin's energy usage. There is an increased understanding and realization, I would say, that Bitcoin should really be used as a store of excess energy rather than consuming electricity from the grid like you and I would, which would then drive up prices for everyone. And that's called, I think, on-grid. So they made that distinction between should Bitcoin mining be off-grid versus on-grid. And by the way, I made this argument in my blog post on Bitcoin the other day, so go check that out on redspark.blog. But there were two discussions I listened in on concerning energy, and in both cases, there were participants that seemed to fully get that this is where the narrative is heading. So in this session that I'm showing here on screen, the guy in the black top in the middle seemed to really get it. Now others were still harping on about how Bitcoin's energy usage is unfairly maligned, which is sort of the gentleman with the baseball cap next to him, and how, the Bitcoin industry is a small percentage of total energy usage. Well, hint, that's irrelevant. You should be asking what percentage of usage, of electricity usage, is it of the grid energy supply, and is it likely to increase? But putting that aside, generally I felt Bitcoiners' thinking was heading in the right direction, so that was good to see. And here is that blog post I mentioned, so feel free to go have a read. So that's it from me. I hope you found that useful and interesting. If you did, consider giving me a thumbs up or leave a comment down below, and consider subscribing if you haven't already. You can also follow me along on Twitter if you want to see my daily musings. Other than that, I hope you all have a great day.